So option is actually a contract, just a piece of paper, a contract between two parties. Okay. So of course, the two parties, there is a buyer, there is a seller. So basically give the buyer of the option the right at a certain price, at a certain time to buy or sell a underlying instrument. That's what the contract does. Okay. So think of it this way, just a piece of paper, okay, between two parties. Okay. The buyer of the option get the right at a certain price at a certain time to buy the line instrument. Of course, the seller will just get what we call the option fee for giving the rights. Okay, so in fact, many of us would have dealt with options before if you have either bought or sold a property. Okay, so in fact, it's actually not the first time you are dealing with options. Okay, you know, when you actually, let's say, for example, today you go for a property viewing, okay, you actually see the property you like. So yes, okay, yes, I'm actually going to buy this today. So you realize that the first thing you actually sign in the property transaction is actually this thing called option to purchase. So by the way, this is the exact same options that is available in stock market. Of course, we call it stock option, but the principle, it works exactly the same. So if you can recall, let's say if you are buying a property, if you actually sign this thing called the option to purchase. So what happened here is this. Then you, of course, after you sign, you have to pay the seller an option fee. Okay. So with this option to purchase, okay, you have the right to buy the property from the seller, okay, within a certain time frame at the agreed price. Okay, you have the right to. Of course, if you want, you can choose not to exercise the option. You can actually choose not to buy. Okay, so it's just a right, it's not obligation. But for the seller, okay, because he actually get the option fees, okay, so he must actually deliver what he promised. So if let's say the buyer decided to exercise the option, take the contract and go to the seller and say, okay, now I want to buy the property, the seller had to sell, no choice. Okay, so of course, for giving away the rights, okay, the seller, okay, will actually earn an option fee. Now, just to make sure whatever I said just now makes sense, okay, can I just trouble you all to answer me this question? If let's say, okay, in a property purchase, you are the option buyer. Okay, you sign the option, you pay an option fee, you're the option buyer. If you so decided not to carry on the purchase, so decided that, okay, I don't want to buy the property anymore, can you do it? Yes or no? Okay, don't mind, please help me type the chat. So let's say you sign an option to pay, you pay the option fee, then you so decided, okay, I don't want to buy the property anymore. Is that okay? Can you actually do it? Yes or no? Okay, thank you, Alan. Alan said yes. Okay, thank you so much. So that is the answer. Yes. So the option just give you the right. If you don't want to bring the deal through, you can. Okay, so that's what option is about. So of course, you can just think of it this way. So basically, a lot of these options signed already. Then after that, you can actually, that contract, okay, to help you visualize, that particular piece of paper can actually be traded in the stock market. Can actually be traded in the stock market. So like, for example, okay, this is what happened here. So let's say today, you want to buy Apple share. Okay, assuming it's 120. Okay, I'm not too sure what price is it today. Let's say it's $120. So if Apple share price rise to 150, okay, your ROI is 25%, as per the calculation here. So now, so US has a very established option market. So instead of go and buy direct the share, you can actually look for option seller. And let's say, for example, the seller is actually willing to sell to this option. You actually give the seller $10, and the option seller will actually give you the right to buy Apple share at $120. So basically, the US market is large enough, there's a lot of people down there willing to be option seller and say, okay, you pay me $10, I give you the right to buy Apple share at 120. So basically the seller will give you a contract. So if the Apple share actually rise to 150, what's going to happen? I will actually take the contract and actually run to the seller and say, hey, look, you have agreed to sell to me at 120. I will buy at $120. And of course, after I buy the stock at $120, I can immediately sell to the stock market at 150 and profit of $30. Okay. So, okay, this is what we call a derivative market. So options is actually a derivative product. Right? Its value of the contract is actually derived from another underlying instrument, which in my example here is actually Apple share. So you may be wondering, is there enough people out there to sell this option? Yes, there's tons of people down there when you sell this option. So if you cannot visualize, all I can say is this: investing is actually a very creative market. We can actually sell papers up to billions of dollars. So that's how creative this the investment market is. So of course, if you do so, you buy at $10, eventually you make $30. The ROI is easily 200%. Okay, so again, just to make sure everyone is on the same page, if let's say, for example, the Apple share dropped to $100, if the Apple share dropped to $100, if you are the option buyer, will you still want to exercise your right to buy from the option seller the stock at 120? Yes or no? Okay, here is the question. If assuming Apple share actually instead of going to 150 drop to $100, will you still want to exercise the option? Yes or no? So can I just get some answer, please? Of course, those in Facebook, please join in to give us your answer. Okay, thank you so much, Ellen. Thank you. Anybody else? Okay, thank you so much, Mike. Okay, correct. Thank you so much. No. Then of course the option will just expire worthless. Okay, as an option buyer, what do you lose? You will just lose that $10. That's what option is about. Okay, so hopefully give you an idea what actually option is. In short, it's a piece of contract, a paper between two parties. The buyer get the rights to buy at underlying price, and of course the seller will get the option fee. Okay, now the other very basic thing about options I want to share with you is the different trade plans you can do with options. So this is the uniqueness compared to stocks. And why? Because of the different trade plans, okay, it's actually possible for you to generate a regular income, in fact, up to a monthly income. Okay, now, so there's actually 4 basic profiles, as you can see here: buying a call, buying a put, writing a call, writing a put. So basically, writing also means selling. Writing means selling. So as a finance professional, we also want to be atas. Also be atas. So selling, we don't say selling, we say writing a call, writing a call, writing a put. Okay. Now, if you eventually go into options, this is one diagram you must be able to understand. This is what we call the payoff diagram. This is what I call the payoff diagram. So the x-axis which we have is the profit or loss. Y-axis is the price of the underlying stock. Okay, so that's how the payoff diagram look like. X-axis is the profit and loss. Y-axis is the profit and loss. X-axis is the price of the underlying stock. Okay, so let's say, for example, I just do something plain, no options here. No options here. I just buy a stock at $55, as you can see here. So top right corner, I buy a stock at $55. Okay, so obviously, if let's say the stock price increase, I profit. The stock price loss, okay, I will actually lose money. Okay, so please help me type a 1 if whatever I say just now makes sense to you. It's actually clear, because it's actually going to get more and more complicated. So whatever I've said about payoff diagram, if you understand, please help me type a 1 into the chat, please. Thank you so much. Okay, great, great. Thank you so much. So of course, those in Facebook, please help to do the same. Please help to type 1 if whatever I talk about the payoff diagram is something that you can comprehend. Okay, great, great. Thank you so much. Okay, now, so let's analyze option with the payoff diagram. Let's analyze option with the payoff diagram. Now, so this is what happened here. Assuming that the current stock price is $55, okay, you actually buy a call. Okay, now there's a few terms here that I need to go through with you. What is a call? A call gives you the right to buy the underlying instrument. Okay, again, what's a call? A call gives you the right to buy the underlying instrument. So of course, when you buy a call, you get the right to buy the underlying instrument. So if you, of course, sell the call, you give the right for your buyer, okay, to buy the underlying instrument from you. Okay, so there's actually this thing called a call premium, which is basically the option fees. So to buy this call, okay, it actually costs $5. And there's actually this thing called the strike price. Okay, strike price is the price that you are agreed to transact in. Okay, strike price is the price that you have agreed to transact in. So basically, this is what happened here. If let's say you buy a call, you actually pay for $5, okay, and you have the right to buy from the option seller, okay, of the underlying stock at $50. That's what it means here. Okay, so I repeat, so based on our data here, you're buying a call at $5 and you have the right to buy the underlying instrument from the seller at $50. Okay, now let's go to the payoff diagram. So of course, if let's say, for example, the stock price increase, okay, stock price increase. So what's going to happen? So let's say the stock price becomes $70. Okay, you would actually want to exercise your option. Why? Because with this option, you can actually buy at $50 and after that sell to the market at $70, for example. Then you actually make money. Okay, then obviously, if let's say the stock price drop, okay, let's say, you know, the price dropped to, like, for example, $30. Okay, so I don't think you will actually want to go to the option seller and say, okay, I want to buy for $50. It doesn't make sense. So very likely, okay, you will just let the option expire. Okay, you just wasted that $5. And in this case, your maximum loss is actually only $5. Okay, so with that, from a payoff diagram, it looks like this. If you buy a call, if the stock price drop below $50, okay, you make a loss, and your maximum loss is actually $5. But if the stock price actually increase, okay, if the stock price actually increase, of course, you will exercise your options, okay, and then of course you can see that your profit can be unlimited. So this is how a payoff diagram look for buy call. So as you can see here, if you buy a call, you can actually limit your loss and have unlimited profits. Now let's go to sell call. So basically, if the payoff diagram perspective, the buy and sell call will just be opposite direction. Okay, because like I said, it's a contract. Okay, it's a two-party. If whatever the buy call, whatever it make, will be the loss of the person that sell the call. Okay, so as you can see here, whatever the profit that the person that buy the call makes, okay, it will be the loss of the person selling the call. Okay, so you can see that's exactly opposite. Sell call actually binds you to the obligation. Okay, if you sell a call, it's not the right anymore. You have the obligation to sell the underlying instrument. You must sell the underlying instrument at the particular strike price. Okay, so that's why if let's say the price increase, then your option buyer, very likely he will exercise the option. And no matter what, you have to actually sell the stock to him at $50. Okay, you have to sell the stock to him at $50. Then of course, if you just buy from the market, you will actually be making a loss. Okay, so one thing very important here. So eventually, if let's say you indeed do options investing, okay, so remember this payoff diagram. Okay, remember this payoff diagram. Okay, so you can see that your loss can be unlimited. Your loss can be unlimited. So this is what we call a naked call. So this is a technical term. I'm not joking about this. This is a technical term. So if you ever become an option investor, please remember this word called naked. And long story short, never go naked. Never go naked. So because your loss can be unlimited, very dangerous. Okay, very dangerous. So that is the profile of a sell call. The other one is actually what I call puts. Puts. Okay, what's the difference here? If you buy puts, you give you the right to sell the underlying instrument. So just now, if you buy call, you have the right to buy buy the under. Yeah, okay, just now when you buy call, right, you have the right to buy the underlying instrument. Now when we talk to sell call, now when we talk to buying puts, okay, we get the right to sell the underlying instrument. So you can actually sell the underlying instrument, okay, at a particular strike price. Okay, you sell the particular instrument at a particular strike price. So like for example, this is what happened. You buy a puts and you have the right to sell it at actually $50. You have the right to sell the underlying stock at $50. So of course, if let's say the stock price drop, let's say to $30, what's going to happen? You'll happily go to the stock market to buy at $30. Then after that, you actually sell to the option seller at $50 and you make that $20. Okay. So once again, if let's say what I will say just now is very confusing, okay, this is what the payoff diagram is actually here to help. So with the payoff diagram, it's actually very clear. So to compare between buy puts and buy call, you can see, okay, under buy call, you will make money when the price increase. Can you see? And under buy puts, you will actually make money when the price decreases. So that is the main difference between buy call and buy put. Okay, so again, if you sell puts, same thing, then you have the obligation to buy the underlying instruments. Of course, you actually make the option fees, that's a maximum profit, and at the same time, you also can incur unlimited loss. So take note, naked puts are unlimited loss. So that is something you have to be very careful of. Okay, so by the way, options is actually considered as a higher risk instrument compared to stocks, bonds, so on and so forth. So these are very standard labeling. So they are indeed actually more risky. Okay, so yes, if you really indeed want to be an option investor, please make sure you know how to manage risk. So this is actually one of the a very basic risk that we're talking about. You can actually make unlimited loss. So like in this case, yes, you may maybe collect $5, but your loss can be actually very huge. Of course, maybe you get Xiong Yo to share later what is some of his very scary losses. I think he made in just one night. I'll just complete this small part before I let Xiong Yo bring you through his actual option trading platform. Okay, now we actually talk about the strategies we can actually use with options. Okay, so one of the main strategy here is this: we can actually profit from a down market. Okay, we can actually profit from a down market. So like for example, if you want to buy stocks, if you want to profit from down market, is not say cannot, is of course is not so commonly available. Okay, but for options, it's actually something quite commonly available. Okay. So how do you actually profit from down market? Let's say, for example, I think that the price is coming down. So as per one way, as you see just now, you can simply just buy puts. You buy puts. If you believe that, okay, now market is overheated, you think that the market is correct, market will come down. So how do you benefit from it? You just buy puts. Okay. And of course, if let's say indeed the market come down, then you actually make your profit here. If the market do not come down, your loss is just going to be kept at the premium that you actually paid. So the other way is actually what we call covered call. Covered call. Okay, so this is actually what happened here. You actually own the underlying stock now. So this is already for people who actually have the underlying stock. So let's say, for example, I have this stock called Starbucks. And I know that I never want to sell these stocks. I want to keep it for my daughter, for my grandchildren, so on and so forth. Okay, I want to hold these stocks for long term. I don't want to sell. So while holding this stock, okay, I am able to maybe just generate a little bit more money through this strategy called covered calls. Okay, covered calls. So this is what happened here. So I own the stock. Then, of course, I think that, okay, now this price is very high. Very likely the price is actually going to drop. So I can actually do this thing called sell call. Okay, I can sell call. So when I do that, what's going to happen? I actually earn the premium. Can you see? I actually earn $5 more. Okay, I sell call. Or maybe I just walk through the example here. So assuming down the stock price is $50. Okay, call premium is 5 and the strike price is $55. So I can sell call with the strike price of $55. Okay, and let's assume that maybe I buy the stock at $50. Okay, I bought the stock at $50. Okay, I have no intention to sell anyway. Then after I can sell the call. So if the price drop to $40, right, the option is actually not exercised. So I actually make from $5. Okay, so of course you can argue saying that, hey, but you actually lost $10 in the stocks. So that's why, okay, the assumption here is this: you have intention to actually keep the stock over long term. Okay, it is your intention to hold the stock over long term, or this is the stock you already have. So that's why, yes, this loss, you actually do make a loss, but this loss is temporary. Okay, if you believe that over long term the price will go up, of course, eventually you actually make back from this particular stock. Okay, now, so why do you actually do a covered call? So let's say, for example, you are wrong. Okay, you actually thought that the price will drop, but in fact, the price actually went up. So obviously, the price went up. The option will be exercised. And in this case, you will not have unlimited loss. Why? Because you have the stocks to help you to cover the loss. Okay, so this is one strategy. So basically, like for example, just now there's a question. So should we just focus on buying? Yes, if you want to be safest, yes. But if let's say your objective is to create regular income, okay, you may have to depend on some of this option premium. Okay, make money from some of this option premium, okay, to actually create that income for you. So this is one of the strategy you can actually perform. So earning fixed income, so of course I think is actually quite obvious. So one is, of course, this is exactly the same covered call. Okay, you actually own the underlying stocks, and after that sell the call, and of course you earn the premium. Okay, so what we actually want to say here is this: if let's say okay, same numbers, let's say you sell call with a strike price of $55. You buy the stock at $50, exactly the same as what we say just now. If the price increased to $60, for example, the option exercise, okay, you options this $5, you profit. And of course, the stock, you also profit of $5. Why? Because you actually sold at $55, even though you buy at $50. Okay, also this is a very likely case. Now, the other way to earn fixed is, of course, you can sell puts. Okay, sell puts. And just now what we mentioned here is this, after you sell puts, right? Okay, there is a chance for you to get unlimited loss. How do you actually protect this unlimited loss? Is that you be ready to buy at the strike price. Okay, you'll be ready to buy at the strike price. Again, let's work through this number. So let's say, for example, now, the current stock price is $55. Okay, put premium is 5 and the strike price is 50. Okay, to do this, that means you are prepared to actually buy the stock at $50. And being prepared means what? You already have the money set aside, okay, to actually buy at $50. You want to buy at $50 in any case. Okay, now the stock price is 55. You want to buy at $50 in any case. Okay, so that is the mindset you have, and of course you have the money set aside. So if let's say, of course, if things are in your favor, indeed the stock price increase, okay, then you just keep the option fee. But if let's say things are not in your favor, it actually dropped even to $40, for example. Okay, for you it's okay. Why? Because you already prepared to buy at $50. So that is another way to break away from this, what we call a naked put. So these are the two ways you can earn fixed income from options, either sell call or sell puts. But please take note of the risk mitigating measures that I mentioned just now. Okay, so of course you can also use options to protect downside. So one most important is you just buy calls. So instead of suffer from the price fluctuation, so if the market goes up, you make money. Markets come down, you actually cap your loss. I think that is actually quite obvious. Okay, and of course, these are some of the different ways. Okay, options can be implemented differently from stocks. So in short, why options is actually better able to generate regular income because of these two things. Okay, for options, you can benefit from both up and down markets. So like, for example, for stocks or for real estate, so most of us, we just want to do like buy low, sell high, buy low, sell high. We only generate when the market is up. Okay, but options is different. Okay, you can actually generate from both up and down market. So the other reason why options has a better chance for money income is you also can be an option seller. You can actually earn the option fees. So that is the difference.